How much do you need to retire? It's one of those difficult questions that most people flounder with when they try to come up with an answer for themselves. Now, the good news is it's surprisingly easy to calculate that once you know two key pieces of information. So in today's video, I'm going to walk you through what those key things are and exactly how you can calculate it so you can understand what you need to retire. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So as we jump into this today and walk through a framework for understanding how much you need to retire, let's start by asking this: how much do you think you need? Now, if you just imagine, wherever you're watching this video, stop for a brief second and think, do I have a number? Is there a number in my head that I've calculated I need? Is there maybe a nice round number that I think is probably the right answer? Do you have a number? If so, say yes or no in the comments. Would love to see how many people actually have that number. Now, most people don't actually have an answer to that question. The good news is even though there's many details and variables that impact this, things like inflation and taxes and cost of living adjustments and all that, there's two simple things we can do to get a good answer. And those two things that you need is number one, what are your expenses going to be in retirement? And number two, what portion of those expenses need to be covered by your portfolio? Now you might be saying, how on earth can you calculate a portfolio need with just those two expenses? Well, let's walk through an example to show you how. Let's start with your expenses. Now I've talked on other videos and podcasts about how do you actually determine your expenses in retirement. It's something that many people struggle with. Well, there's two ways. There's the top-down approach and there's the bottom-up approach. The bottom-up approach says start with a spreadsheet or start with a piece of paper and say, what are all my expenses going to be in retirement? This could be groceries, this could be cell phone bill, this could be travel, this could be property taxes. Literally going through to say, what are all my expenses? What are those expenses going to be? So assign a dollar amount to each of them, add them all up, and that's your expenses. Now that takes a lot more detail, but that's how you get a real precise sense of what your retirement expenses will be. Now, if you say, I do not want to go through that exercise, or I have no idea even what expenses to account for, there's an easier way that will get you very close. This is the top-down approach. The top-down approach says take your take-home income today, assuming you're still working. Now, with your take-home income today, assuming that covers all your needs, well, can we just maintain that income throughout retirement? But the good news is we probably don't need to maintain all of it. Here's an example. Let's assume you take home $10,000 per month after taxes to use a nice round number. Well, if $10,000 a month is coming in, but you're paying a mortgage, and let's assume the principal and interest portion of that mortgage is $2,000, and that mortgage will be paid off by retirement, well, you don't need $10,000 per month in retirement. You need $8,000 because $2,000 of those expenses will be gone. Then let's also assume you're saving a couple $1,000s per month to send kids to college or to a Roth IRA or whatever it is. Well, by the time that you retire, you don't need to save for retirement and you've likely sent kids to college or maybe have some money saved up to cover the rest. Well, if that's the case, $10,000 is coming in, $2,000 can be backed out for mortgage, $2,000 can be backed out because you no longer need to save for college or retirement when you're in retirement. That leaves you with $6,000. Now maybe you want to add something in or take more stuff out, but really what you're doing is saying, what am I spending today? What are the big expenses that will either be added to that number or taken out of that number? And then we maintain that throughout retirement. So in this example, maybe $6,000 per month is what you're planning on. So regardless of how you do it, and you don't need to be perfect with this, most people aren't perfect their first time around, but you have to start with something. That's step number one. So start there, determine your expenses. In order to use an example to now cover step number two, let's assume that whether you use the bottom-up approach, the top-down approach, you come up with, let's say, $100,000 per year. $100,000 per year is what you need to retire. Again, the number itself is not important as much as the framework of how do we think about this. Well, when you look at that and you say, okay, I need $100,000 per year, and maybe I'm going to expect to live 30 years in retirement, that can seem quite overwhelming. So, oh my gosh, do I need $3 million in my portfolio to support that? 100,000 per year times 30? Well, probably not. For most people, no. And that's where we go to step number two. Step number two is saying of those expenses, how much actually have to come from your portfolio? And I say how much needs to come from your portfolio because odds are good you have some other income sources. That could be a pension, that could be Social Security, that could be rental income, that could be part-time work. This could be a number of different things. But what we want to do is of the amount that you need to retire, so $100,000 in our example, whittle that down to how much actually needs to come from your portfolio. Now, because everyone has different non-portfolio income sources, this number is going to be different for anyone. If we have 10 different people in a room, And all of them say, yeah, my retirement expenses are $100,000 per year. That doesn't necessarily mean they all need the same exact portfolio to support that, because they all probably have different income sources. And let's actually look at two examples so we can compare and contrast how things change. Let's look at the first example of a married couple. And with this married couple, let's assume one of them has a pension of, say, $16,000 per year. One of them has a Social Security benefit of $3,000 per month, so $36,000 per year. And the other has a spousal benefit of $1,500 per month Social Security, which is $18,000 per year. So pension $16,000, one Social Security benefit of $36,000, and another Social Security benefit or spousal benefit of $18,000. When you add all that up, that's $70,000 per year. So this couple that wants to live on $100,000 per year, 70% of that is already covered by non-portfolio income sources, which means the difference, that remaining $30,000, that's what needs to come from their portfolio. So what you can do from there is just apply a withdrawal rate to that. Let's assume they've determined that based upon their age and their portfolio mix and how they're going to withdraw money from their portfolio, they can take out 5% per year. Well, what you do is you take that $30,000 that they need from their portfolio, divide it by 5%, and what that gives you is $600,000, which says to this couple, if you have $600,000 in a portfolio, you could take out 5% per year, which represents $30,000, and that $30,000 would then be added to Social Security and pension to give the full $100,000 that would allow you to meet your needs throughout retirement. So when this couple says, how much do I need to retire? The answer, with this simple example, is $600,000. Now let's look at another example. In the second example, let's assume we're looking at a single person who's not married. And let's assume that this individual owned a business and maybe didn't pay a lot into Social Security. So this individual has a Social Security benefit of $1,000 a month, so $12,000 per year, but no pension, no spousal benefit, no other income sources outside of their portfolio. Well, if this individual has $12,000 per year coming in from Social Security, what that's telling me is $88,000 per year needs to come from investments to, again, live on $100,000 per year total. If we apply the same 5% withdrawal rate that we did in the other example, what this means is this individual would need $1,760,000 in their portfolio to support $88,000 per year. Again, we're taking $88,000, divide it by 5% to come up with a portfolio value of $1,760,000. So take a look at these two examples. Both of them want $100,000 per year to live on. One of them, in one example, needs a $600,000 portfolio to make that happen. The other individual in the other example needs over $1.7 million to make this happen, about 3 times as much. The difference was how much each of them had in non-portfolio income sources. So you can start to see here, if you know just 2 details, you can get very close to understanding exactly how much you need to retire. So of course, it's really important to know what will your actual retirement expenses be. And then once you know what will your non-portfolio income sources be, you can understand the difference between those two. What do I need and what do I have before portfolio? That difference needs to come from your portfolio, and you can use that number to calculate what your portfolio needs to be. Now I say this is going to get you close, so I want to be very clear there are more details that would help you really get a precise answer. When you start to factor in things like taxes or inflation, or does your pension have a cost of living adjustment or does it not? Are there other things like inheritance or family support or sale of property? There are so many different things that could impact this, but this is going to get you 80 to 90% of the way there. And for most people, at least give them a general sense of how much approximately do I need to be able to make this retirement thing happen. So let's quickly walk through what some of those other details are, just so that you can be aware of them as you're planning for your situation. The first is taxes. Now, it's simple enough to say, okay, I'm in a 10% tax bracket or 20% tax bracket, and I can just add that on to my expenses. But you just have to be mindful of the fact that IRAs versus Social Security versus brokerage accounts versus Roth IRAs, they're all taxed differently. So make sure you have a detailed analysis of what will your actual tax bracket be when you combine multiple different income sources. Number 2 is inflation. So what's inflation going to be over time? Now, if you're using standard withdrawal rate rules, whether it's the 4% rule or guidance approach or whatever it might be, there's an inflation factor that's already assumed there. It's assumed that you're going to take a withdrawal rate that increases with inflation. But then you look at things like Social Security. Well, Social Security also has a cost of living adjustment. Maybe it doesn't perfectly keep up with inflation, but it's fairly close. The big thing is, do you have a pension? If a pension's making up a majority of your income needs, and it's a private pension, chances are good there's not a cost of living adjustment on it. So your pension day 1 of retirement The amount's going to be the same forever, but the purchasing power is going to diminish each and every year. So understand the impact of inflation on your expenses and understand how your different income sources will adjust for that. Third is marital status. And this isn't just because, okay, if you're married, maybe you have one spouse that's spending more than the other. No, it's because of tax brackets. If you're married, you have higher thresholds until you hit certain tax brackets. On top of that, you have double the standard deduction. So when you look at a single individual and a married couple that are both living, whether it's $50,000, $100,000, $200,000 per year, for the same level of income, the single individual is going to be subject to higher tax brackets. So even understanding how that works is going to be impacting your living expenses. Fourth is insurances. So as you look at this, it's not just going to be consistent expenses throughout retirement. If you retire before 65, you're going to need a health insurance solution. Now that might be extra expenses until Medicare kicks in. Maybe you're also looking at long-term care, whether that's the expense of long-term care insurance in the first several years of retirement, or it's the expense of an actual long-term care event later in retirement. How are you factoring in some of these other factors on top of just a basic living expense? And then fifth is lifestyle changes. It's very rare that you start spending one amount in retirement and that amount just increases perfectly with inflation over time. You have what's traditionally called the go-go years when you first retire. You have your health, you have your energy, you just retired, there's an excitement to do things. You're really living large those first several years in many cases. Then you have the slow go years, where you're still healthy, but you're maybe not quite as energized as you were before. Maybe it's not quite as easy to get around. Your expenses start to drop. Then you have the no-go years. The no-go years are the later years of retirement. Maybe there are health issues. Maybe there are long-term care needs. Your expenses might actually start to rise a bit as you need to fund these expenses. So when you look at that, don't just plan on one single number forever, but understand how will different phases of retirement cost different amounts. So those are some of the details to be aware of. But if you go back to those two key pieces of information that we looked at, one, what are your living expenses in retirement? And two, how much of those living expenses need to come from your portfolio, you're going to be most of the way there. Now, if you go through that exercise and you say, yeah, I'm feeling pretty good about my ability to retire, well, then be sure to check out this video here, where I walk you through the 5 reasons that it might be time to retire right now. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.